All right, everybody, welcome back to another episode of the Discovering Multifamily podcast. I'm one of your hosts, Anthony Scandariato with Red Knight Properties. And today we have a special guest here with us, Bruce Wuollet. And Bruce is with Bakerson. He's the founder and visionary of the company Bakerson. He's based out of Cave Creek, Arizona. He's been in multifamily for, almost 20 years, right, Bruce?
Been in real estate 20 years, multifamily for about 7, yeah.
Okay, real estate for about 20 years, and good time in multifamily. And today we're going to talk about he's got about 1,000 units and 20 multifamily deals. Before that, he was in single family rentals, SFRs. And today, we're recording this kind of early Q2 of 2022, and a lot going on right now with interest rates rising, and macroeconomic conditions that are different from where they were in 2021 or starting to become different. So, we're going to talk about how Bruce is preparing for potential future opportunities in this market. What is he doing to protect himself and his investors? And just what does he see, the state of the market going forward? So thanks for coming on, Bruce.
Hey, thanks a lot for having me on. I'm looking forward to the conversation.
Great. So, given your background in multifamily, you got almost 1,000 units right now and only doing this 7 years. It's a pretty short amount of time to gather that many units. So what are you guys focusing on in terms of what type of asset class in multifamily, and what type of risk profile are you looking for? And, how are you adjusting your return profile, or are you not doing anything, or are you raising cash? When interest rates are rising and market dynamics are changing from the past couple of years.
Yeah, well, the biggest thing we're continuing to stick within our buy box. Our buy box is under 150 units, under 20 million, Class C workforce, and our focus is what we call the permanent resident, one who may never own a home, like to live in one. And it's they're above the poverty line, but they're below lower middle class, upper lower class. It's kind of the primary focus. And in this current economic cycle that we're in, it feels to be, and I think it's mathematically proven to be the most underserved economic demographic is the lower middle class and upper lower class. They're getting priced out of so many markets, such as Phoenix, where I live. We live in the Phoenix metro, and it's difficult for them to find places to rent. So we're seeing that as our primary focus. 60s to 70s build, a lot of deferred maintenance, high vacancy is preferred, which is really hard to find in Phoenix. So we haven't bought in Phoenix for some time. We're pursuing now in New Mexico and Texas. We're able to see some opportunities that fit our buy box. And as far as the current conditions, we're seeing interest rates are rising. The good news is the cost of equity, especially if you get into some preferred equity, some institutional equity, those costs are coming down a little bit, and then rents are going up. So right now, those are being covered. So for the foreseeable future, I think we'll be fine where the prices are going to continue to rise some, especially in the hotter growing markets. But is it sustainable? That's the question that we don't know. And instead of saying, yes, it is, or no, it isn't, or this is what the market's going to do, we just know that markets are cyclical. We are going to see a downturn. We are going to see economic impact. And I think it's important to always be prepared. My mentor is a very wise investor. He's got 50 plus years experience in multifamily, and he continues to buy cash flow. So right now we're seeing operators that are buying pro forma and selling pro forma, and there's probably nothing wrong with that business model. It's just not my business model. To me, it's very risky. So we're going to focus on buying cash flow. And Anthony, I'm sure you're aware that buying cash flow right now is very difficult because people are profit taking and they're selling their values, their property on future income. And there's enough investors that are willing to do that right now. But eventually the merry-go-round is going to stop. And we'll have to, at that point, analyze where we're at and whether or not we're able to financially be stable enough to get through a downed market. And I think it's important for us to look at that.
Yeah, and talk to us a little bit more about that in terms of what type of debt structures are you putting on your deals as of right now, especially if you're looking for just income producing properties. Are you, what's your general unit size you're looking at? Because as you mentioned institutional capital, the higher unit counts you get under one transaction, you have a lot of lower cost capital providers chasing those opportunities. So they're able to pay higher numbers than, private individuals or, private companies like Bakerson. So, what type of archetype for the asset class are you mentioned workforce housing, but, any deal size you're trying to stay under or over? What does that look like?
Yeah, under 150 units. We've done, in our history, anything from 6 to 120 units. We have 152 unit in escrow right now. So that'll be our largest one, but most of them are under 100 units, and the 75 to 100 seem to be good in a sense of, the staffing. You have one property manager and one property manager on site, and then a maintenance person on site at 75 units, and then 100 you might have 1.5, some part-time. And once you have multiple properties in a market, you can share. But I do like smaller ones as well. We will buy 30 to 40 unit buildings if the price is right. Now they have to be pretty low cost per unit, like the one we have in Albuquerque is 36 units. My son and I bought that one, and we bought it for just under 42,000 a door in January, which is pretty unheard of. I mean, it's cash flowing day one. And so then how do you make that happen? The competing is, I think if you get the smaller, older buildings, a lot of the institutions don't like buildings that are 60s and 70s. They want to be 80s and newer. So by focusing on a little bit older building, I think we can carve out a little niche there where we can pick up some things that are cash flowing and then become experts in that. And we have been experts. We've bought buildings as old as in the 40s and 50s. And it just causes, you have to do a little more due diligence. On the inspection side, you have to make sure that the property is sound and the structure is sound. And then realize that you might have to replace some plumbing, some underground plumbing. It can be a hassle. We've had to do that before, abandon underground plumbing and move it all above ground for a chiller system that we have in Tucson. That we sold that building, but we moved all the chiller plumbing above ground, which is a air conditioning system. It's a master system that is used in the South. So by hyper focusing on that age group, you bump out a lot of equity groups. And then also if there's vacancy issues, then you bump out some more. The challenge is, of course, then the financing. So if it's highly vacant, you're looking at 10-12% interest still for a private money, which is really high, and that won't cash flow very well. So what we're getting now is bridge debt until we're fully stabilized. And one of the reasons is it's shorter escrow. You can get bridge debt to close quicker than a Fannie or Freddie loan. You can still get pretty good bridge debt. Then you have to decide, do you want to get locked in at an interest rate of 5.5, or are you willing to do 4 with adjustable rate? Because the rates are going up. We're seeing that. So if you do adjustable rate, then you have to decide, do you want to buy the cap to limit how much it can go up? The cap insurance is very expensive right now. So you have to look at every deal, each deal independently and decide what makes the most sense for you. But we like bridge capital still.
Yeah, and how are you sourcing your deals for the most part?
Right now, the last few have been through brokers, and one of them was listed on LoopNet. So that's not a really active place to find multifamily. It wasn't it was not a highly marketed property. The other one is, by the way, through brokers primarily. We've done a few direct to owner purchases, but they're more far and few between. So broker relationships are good. And one of the advantages is you try to buy when there's an ice storm in the Dallas-Fort Worth area, because people are not flying in to look at it, and you go in anyway and you drive around in that crazy weather. So and then tell them, hey, what does it take to not do a call for offers? And then you can get a deal that way. That's what we did on our last one. And but timing that obviously is difficult on weather. And it's probably not a good business model. It's just a little bit of fun that we ran into.
Yeah, I have a little bit of happenstance that actually happened to me on my home that I actually purchased. Drove right in the middle of a snowstorm, and they were doing an open house and ended up working out a deal. That's great. So mostly brokers you're sourcing your deals from. In terms of the competition, as you mentioned, our niche within the multifamily industry, your thought is probably not going to be, you have to be careful, but in terms of, the shortage of workforce housing and kind of the whole dynamics of the supply and demand imbalance, and obviously rising construction costs, tough to build, affordable housing. There's a lot of positives, and it seems like there's still a lot of runway with the type of product. And I buy, my company, Red Knight Properties, focuses on the same thing. I guess, um, have you seen competition kind of dwindle a little bit on some deals? Or you mentioned you're going into a couple of new markets because of cash, different business strategies. Um, like what are you doing to set yourself apart? Is the market still crazy competitive as it was, 2 months ago? I'm seeing a little bit of fall off. Just some groups are not bidding anymore, which is actually a good thing for the people who have been around for 20 years. So
And the question comes, some people get nervous when the market's hot, that's too hot, but then when it starts cooling off, they start looking at, wait, why are they not buying? What am I missing out on? And just remember to buy the cash flow. And then the challenge we're going to have really is if you're going to refinance out of a bridge product and hold it, because we're going to do legacy hold, hold and really no end date in sight. 7 to 10 years is our business model, but who knows where it'll be then. Throughout the cycle of ownership, we'll decide, do we continue to own it or we decide to sell? What's the opportunistic time? But so trying to get in and out of the debt in 2 to 3 years, I think is probably safe, but we're going to start running into 2025, 2026. We might start running into some lending issues, especially if the market if the cap rates go up and interest rates continue to go up, it's going to squeeze out some operators, and it's also going to cause some debt structure to change. We have to bring in a little more capital to close, which will be a challenge. You don't want to come into a refinance and have to do a capital call with your investors and say, hey, we got a really good loan, but we got to bring in another X percent to get this loan. And it's going to dilute their return. It's going to affect their ability. So you want to prepare for those times. The other thing that we're doing that's really been helping us is we've increased our expenses quite a bit. Probably 20% over what it was a year ago or a year and a half ago, just because we're going to see expenses go up with inflation. And so we are pushing our expense ratios, our expense amounts up quite a bit. And I think that will help, because then when it comes down to it, we realize that, hey, we still have a really good NOI. We can still get a really good loan because our expenses are less than projected. Because I see some of the operators are putting out numbers and they're not putting anything more in expenses. And I'm pretty surprised, actually, because expenses everywhere are going up. Utilities are going to start going up, and costs of materials is high. Labor is going up. We're seeing labor go up actually quite quickly in some of the markets. So those are things that I think if you put those right things in place and if people think it's going to go up 10%, put yours up 20% in your business model. Then when you actually have an NOI, you can cover a lot with a strong NOI. So I think that's very safe to do.
yeah, I agree with that.
But as far as said,
go ahead.
Your question was, how are we setting ourselves apart? And not setting ourselves apart to our investors. But as for the offers, if there's a call for offers, I've never won that. I've never won that bid. So the biggest thing is just get in and ask the question that, what does it take to not take a call for offers? And that's what we do. So between that and then taking care of the investors on the expense, I think is very important.
Agreed. And it's interesting you bring up the expense ratios and, cost per unit, and, people have a bunch of different metrics they're looking at. Is there anything that you're seeing in terms of probably not any increased vacancy? Turnover is still pretty low, if I had to imagine. So it might wash itself out from a regular pro forma kind of pre-pandemic times. Is that a fair assessment somewhat with what you're seeing, what's going on? For some of our models, we're not projecting, let's say 20% rent growth and then 10% expense growth. It's just, we would never do 20% rent growth anyway, but how are you kind of managing that balance between the two? Because, one could offset your NOI growth either lever could offset your growth really quickly.
Yeah, and that's why the buying the cash flow on actuals is what we're trying to do is based on what is the best case scenario actuals, and then what is the worst case scenario stress test, and kind of find that balance. But the biggest thing is to buy on fundamentals. It's Warren Buffett's, he buys stock on fundamentals. And I think that buying real estate on fundamentals is a much safer, especially in this stage of the cycle that we're in, that we be careful to buy on the fundamentals of the project. Is it cash flowing on actuals? And if it's not, why is it not? And then why is your business model actually going to work? And there's a guy that we met at a conference in Dallas last month, and he said that he's on a deal that he's backing out of with his partners because they're putting 10% rent growth in Phoenix for the next 3 years, 10% each year. So it's 30%. And he says he thinks that's dangerous. So he's pulling his money out of that deal with his partners. And I thought, wow, well, it could happen. There's high demand. But what people don't realize is, yeah, there's high demand. But if the interest rate drops, interest rate continues to go up and the cap rate goes up and vacancy is still high, but you can't push that lever indefinitely. You can't pull that lever indefinitely. How are they protecting themselves? And it's a question that we need to ask, because we're not going to see that rent growth indefinite. People say there's so much demand, it can't end. And I agree, based on demand alone, there's no end in sight. We need this. But you and I know that if the interest rates go up to 6%, 6.5%, if we start seeing mortgage rates going up to that rate, it completely kills the model. It's going to affect the value of the property, and it will. And if materials are continue to be high, it'll affect the ability to build. And if rents can't go up because you've already pushed it to the maximum of the market, you're going to have a problem bringing units to market, and that's going to trickle down to every level of apartments. So I'm a little bit bearish on it right now, just because I do agree there's a shortage, but that in and of itself is not going to sustain if the interest rates continue to go up.
Correct. And for you, and we have some opportunities where, like you said, we're in this for the long haul. Some deals are different than others. You can get in and out a little bit quicker. But if you're forecasting, especially over 3 years like that, maybe 1 year I'd say is okay, but who the hell knows what's going to happen in 2 years? And then even after that, what were they projecting? Even after year 3, it's still 5%. Who knows? And that's a risky assessment. So I would tend to agree with your friend. Bruce, sorry to cut this short, but what's the best way my audience can find you, reach out to you, and learn more about Bakerson?
Oh, no worries on the time. It's fun to be on your show. And the best way to reach me is bakerson.com, Bakerson. And I grew up in the bakery business. So I tell people I'm an SOB. I'm a son of a baker.
Nice. Well, we got a SOB on the show today. It was a great time chatting with you today, Bruce. And if you liked what you heard and or saw, please give us a rating and review on iTunes. It helps Bruce and I get our message out to a greater audience. And, I will have Bruce's social media in our iTunes description as well as on our social media. So feel free to reach out to Bruce directly and connect with him. Thanks so much for coming on, Bruce. I really appreciate it.
Hey, thanks for having me on. It was really, really nice to be on your show.
Great.